The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service Advanced Technical Analysis course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Hello everybody and welcome to another edition of the live advanced technical analysis course. This is webinar number 11 out of a total of 12, so we are approaching the end of this course and that will be tomorrow. In today's webinar we will be looking at three practical areas, if you like, of applying concepts around technical analysis, but also just really a logical approach to evaluating conditions in price action. We'll be looking at ranges, breakouts, considering order flow, and then we'll end off today's webinar with a final note on price confirmation. Forex Academy is an online provider of educational facilities to traders of financial markets and cryptocurrencies. All of the content that you will view in the Advanced Technical Analysis course is educational material with the purpose of introducing you to various tools, techniques, and methodologies under the banner of technical analysis. It will also illustrate how you can apply these various approaches in terms of contributing towards developing a more disciplined approach to both analyzing and trading instruments in the financial marketplace. Before we continue, just a few pieces of housekeeping matters. Please feel free to ask any questions throughout the course of the webinar. You can locate your chat box on the right-hand side of the screen. I will obviously be able to view your questions. This is a live webinar. It is being recorded and will be placed in your members area once the webinar has concluded. As always, at the end of today's webinar, there will be an extended Q&A session, which will allow you the opportunity to ask additional questions and will also give us the opportunity to perhaps go into the issues in much more detail, even perhaps opening up potential for a discussion, which will be to the benefit of everybody involved in today's webinar. This week, the course material has followed the same pattern as we have in previous weeks, whereby in the first 3 days of the week, Monday, Tuesday, Wednesday, we have covered some educational concepts, material, and techniques. And the week will end tomorrow with an end of course workshop. It will be the third and final workshop. And as I mentioned, it will conclude the Advanced Technical Analysis course. The only difference with tomorrow's workshop is that it will not only incorporate the material that we will have focused on over the course of this week, but will also incorporate other methods that we have covered over the entire course to illustrate how you can pool all of these techniques to develop and build a more disciplined approach and strategy towards trading instruments in the financial marketplace. In today's webinar, we will start our discussion off with a look at understanding price ranges. We will introduce to you some techniques and some concepts that will facilitate managing price ranges, understanding breakout trading, in particular when breakout trading is appropriate. We will then look at how you can approach the markets from trading a range. That perhaps will be something a little different to what we've really focused on over the course of the webinars up until now, where we've really focused our attention on trading the trend. Sometimes ranges are wide enough and they offer decent trading opportunities. We'll then move our focus onto order flow, questions to ask around order flow, and we will conclude today's webinar with a brief look at price confirmation. Understanding market conditions through price observation is a primary objective of technical analysis. Hopefully, this is a statement that you will appreciate at this point in time. Whether a market is trending, however, or is range-bound will determine the appropriate trading strategy. So it is very important for us to be able to assess when a market is trending and when it is not. It is essential to understand both trends and range-bound activities if you are going to be looking to trade these two types of conditions. When we look at order flow is information that, if accessible, provides some valuable insight into underlying market conditions. Price confirmation is important when analyzing charts and applying technical analysis techniques. If you are looking for a confirmation of a break of a pattern, for example, you need to understand at what point or where or under what conditions that pattern will be confirmed. We'll take a look at some issues towards the end of today's webinar. So let's begin our discussion with a look at price ranges. Now, you will recall from an earlier webinar that there are three types of trends. Markets are either moving upwards in an uptrend, downwards in a downtrend, but they can be moving sideways or within a range-bound outlook. That is also a trend. So we have uptrends, downtrends, and sideways trends when we talk about trends. A range, it's important to note, can either represent a pause in the trend or the early stages of a reversal. Ranges can be temporary or they can last for long periods of time. Whether they are temporary or either short-lived or whether they last for long periods of time sends out information with respect to market sentiment. The one great thing about ranges is that they offer trading opportunities, and we'll look at how we can approach ranges from a trading perspective. First of all, we can consider range trading approaches, or we can look at a range breakout, or certainly we could apply both. In other words, while the market is within the range, we will apply a range trading approach to this particular market. Once we see a breakout, once that breakout is confirmed, we can then look to execute a trade using a range breakout logic. Confirmation of range breakouts is important. One should always use additional tools and techniques. This is something that we've focused on in previous webinars. It's not just relevant to price ranges, it's relevant to your overall analysis. So tools and techniques such as oscillators, moving averages, and even trend analysis help you gain a better understanding of the range conditions that you are dealing with. Always focus on support and resistance. The one great thing about ranges is that they can clearly define where your levels of support and where your levels of resistance lie. Okay, let's take a practical look at one or two illustrations to illustrate how we can manage price ranges. Now, if we look at this particular chart, let's just make some initial observations. Well, clearly prices have, if we start on from the far left, have moved in an upward direction from the low on the left-hand side of the chart to these highs over here. We've then seen very choppy type of price action, which has ultimately resulted in a move down towards these lows. So we've had two phases, if you like. We've had an uptrend and we've had a not so easy downtrend. The market selling off aggressively, finding support, rallying significantly higher, only to then see a sharp sell-off and once again rally, eventually dragging prices down to these lows. If we look at the more recent activity, we can identify that markets have been moving in a sideways manner. Now, a couple of things to take on board in terms of what we've discussed up until now in previous webinars. The one thing when we were discussing trend conditions or actually price behavioral patterns is that when you see a clear change in the behavior of price, that can act as an early warning sign that underlying sentiment is perhaps going through a change. Now, admittedly, this hasn't been an easy downtrend, but it has ultimately been a downtrend nonetheless, with a sequence of lower lows and lower highs dominating. If we can just highlight the key turning points in the market, we can clearly see that ultimately the market did move in a downward direction. If we look at the most recent price action, we can clearly see that for some time now, markets have been moving sideways. One point to bear in mind is that when consolidation or a range that develops tends to stick around for a long period of time, the longer that range remains in place, the greater the risk that you will ultimately see a reversal. In other words, it's a precursor potentially to a change in sentiment. A range or a period of consolidation that lasts for a short period of time doesn't necessarily represent a threat to the trend. It's some kind of a pause before the market will then continue in the direction it has been traveling in. But in this particular instance, we need to pay close attention to this because the period of consolidation has been in place for quite some time. If you think about it in another way in terms of asking yourself the question, yes, sure, we have had a very choppy downtrend, but a downtrend nonetheless. We've seen a very clear, sharp sell-off during this phase over here. We now need to ask ourselves, why is it taking the market so long to re-establish a downtrend? It may ultimately still continue in a downward direction, but the longer this sideways move remains in place, the lower the chances are that the market will ultimately move down. That is just a simple observation of what is going on in price action relative to what has happened up until that point. So we've been able to establish a price range in this instance. We've discussed some aspects around a price range. And one concern that we would need to have with this particular illustration is whether the market is indeed ultimately going to reverse in an upward direction. We've also been able to see that most recently there has been what appears to be a potential breakout of this range. We did see one over here that failed to follow through, and the market then recovered. It will be interesting to see what subsequent price action will unfold, or what type of price action will unfold following this break, to see whether it does ultimately result in a move to the upside. For the purposes of this illustration, it's important that you're able to firstly establish the fact that there is a price range or a range that has developed, and take on board any considerations as to what this might mean for the trend. As we've just stressed, the longer a range remains in place, the greater the risk is that this develops into a reversal. The one great thing about a sideways move is that we can calculate the vertical distance, and if we do see a clear breakout, then we can calculate the vertical distance of the range, project it higher once we are of the opinion that we've had a confirmed break to the upside in terms of where the market is likely to move to on a medium-term basis. In terms of this particular chart, if you were using an hourly chart, for example, then it would be a relatively shorter term target, but the underlying logic would be exactly the same. So price ranges, you can clearly see, allow you an ability to evaluate what is going on in the market in much the same way that we would have evaluated reversal patterns. If you recall, head and shoulders reversals, or a double bottom or double top, which gives us an early warning sign of a potential shift in market sentiment. We can manage price ranges in exactly the same way. Let's take a look at another illustration. Firstly, let's make a few observations with respect to the price activity that we have in front of us. Well, clearly, for a period of time, the market has moved in a downward direction. It's identified lows down at this point to then subsequently move in an upward direction. The market has found resistance. We've seen some downward pressure develop. The question is, more recently, what are we viewing? And we can see that very clearly the market is moving in a more sideways fashion. Is this going to lead to a move lower, or will it ultimately reverse the recent decline? The longer it remains intact, the greater the risk is then that it moves to the upside. But we don't preempt that move. We simply make that conclusion at this point in time, and we will continue to observe price action. That is the forward-thinking aspect in terms of what we're dealing with. Let's look at two illustrations in terms of how we can manage the ranges from a somewhat different perspective with respect to the price action we see in front of us. If we take a first illustration and we look at the consolidation that took place during the period that has been highlighted in the chart, you can clearly see that the market has sold off quite sharply, and then for a period of time has found a sideways area to trade within, establishing a range. Ultimately, what we see is that the market breaks out of this low, and that then confirms to us that this trend remains intact and that the trend is likely to move in a downward manner. Now, if we just simply look at evaluating the trend up until this point, we can clearly see that the fact that the market broke this low over here tells us that we are dealing with a sequence of lower lows and lower highs. Therefore, until we see a reversal, i.e. a break to the upside, our initial assumption is that this pause is a pause in the downtrend and that we should see price action move in a downward fashion. Certainly, if the consolidation extends for a long period of time, just illustrate a scenario, then the greater the risk is that the market will eventually break to the upside. If it is a short-lived pause in the trend, the likelihood is that the market will move lower and we ultimately see price action move in a downward manner. Come back to that very briefly again. If we, however, look at this area, the most recent area in the chart in front of you, as we mentioned earlier, we can clearly see that a range has developed. Now, one question we can ask ourselves is, what is the width of the range? Is it wide enough to allow me to consider taking on board a range trading strategy? In this instance, if we compare the two ranges, this one over here versus this range that is developed here, we can clearly see that the distance between the top end of the range and the lower end of the range is much wider. So it then would facilitate us to take on board a range trading strategy. We'll look at a range trading strategy in a little later in terms of how we would actually tackle it. All that we're doing now is we are using or evaluating price action to establish our directional bias, something that we focused on earlier, which is absolutely essential before you can take on a trade. In this first sideways move over here, at least initially, the directional bias is down. Therefore, if this is a short-lived pause in the market, we would expect it to move lower. Over here, we may still have a broader directional bias with the market either moving up or down. However, because of the size of the range and the fact that we have two valid points on either side of the range that have been tested, we can conclude that at least for now, our directional bias is sideways, and therefore we are going to adopt a range trading strategy. So that has just simply been a conclusion that we've arrived at by evaluating price action. You can see once again how important it is just for you to observe the kind of activity that sits in front of you and the type of information that you can extract from your observation. If we incorporate an additional tool, perhaps such as the slope of a moving average, something that we looked at last week, we can gain some additional reinforcing evidence with respect to the direction in the market. You may recall from a just very recent conclusion that while looking at this consolidation in the downtrend, our view was that As long as it doesn't extend for too long, this pause is just, or this sideways move is just a pause in the downtrend, and ultimately we should see the market continue to move in a downward manner. This is further reinforced by the negative slope that exists on the moving average that I've highlighted, telling you that the chances are greater that the market will eventually move in a downward fashion. So we're using these tools to further reinforce our underlying view in the market, and also to think about how we can prepare ourselves for a potential trade. If we look at this range, however, we can see that the slope of the moving average has moved from being positive, i.e. defining a trend, to one that is now taking on a flatter slope. The fact that the average is taking on a flatter slope further reinforces the fact that the market is trading within a range, and for all intents and purposes, at least for now, we can come to the conclusion that until we see a breakout of the range, whether that's to the upside or to the downside, the width of the range allows us to adopt a range trading strategy. So we have two very different conditions in the slope of the moving average. It's negative, i.e. defining a trend as down in this instance, and in the second illustration, it's moved sideways, or it's adopting a more sideways or a flat slope, or no slope at all, if you prefer to use that term, and that tells you that the market is, at least for now or for the foreseeable future, likely to continue trading within this range that has been established. Okay, so we've had a look at how we can manage price ranges in terms of formulating our directional view in the market. Let's now turn our attention to breakout trading. It's important to remember that breakout trading is appropriate under certain conditions. One of those conditions is that underlying market sentiment needs to be strong. In other words, the market is driving prices either in an upward manner or an upward motion, or is bearish and pushing prices down. To be able to capitalize from breakout trading, markets then need to be trending. And this is really just an extension of the previous point. If market sentiment is strong, bullish for example, then that is a reflection of a bull trend in the market, or a market that is trending up. It then makes sense that if we consider the three phases of a trend, phase 1, phase 2, and phase 3, you will recall that phase 2 is the trend confirmation portion of the three phases, and therefore it would make sense that breakout trading would be appropriate during phase 2 of the three phases of a trend. Breakout trading is also appropriate in reversals. For example, if you are monitoring a head and shoulders reversal or a long period of consolidation that we just looked at in a previous example, and the market breaks out, you could feel comfortable enough to take on that first trade as a breakout trade, because this is the confirmation that the market sentiment has changed, and therefore that the trend has indeed reversed as well. Your view will be that you are expecting an impulsive follow through on this initial breakout confirmation. So breakout trading is also appropriate when a reversal is confirmed. It's important to note that breakout trading is appropriate under a low volatility environment. Now, when markets are trending, i.e. if we look at the second point, and when markets are in phase 2, then it is most likely that the market is currently trading within a low volatility environment. Trends in markets are a reflection of low volatility. Volatility tends to increase when markets move in a more sideways manner, because what you are seeing greater swings within a defined range over a period of time. Whereas with a trend, pullbacks are generally relatively shallow, and the market is moving in one direction or the other, either up or down. So low volatility is another criteria for range, or rather for breakout trading. Also, we'd prefer to trade breakouts in liquid markets. If you were to take a look, for example, at the foreign exchange markets, and the most liquid of all the pairs is euro-dollar. If you believed euro-dollar was in a trend for now, this trend doesn't really matter whether you're looking at a 5-minute chart, whether you're looking at an hourly chart, or whether you're looking at a daily chart against the backdrop of a trend that's been around for 2 months. The principles and the logic are exactly the same. Important though that we have a liquidity issue that will facilitate breakout trading. So markets need to be liquid. If you were trading euro-dollar that was trending and you felt comfortable trading the breakout, that would be fine because euro-dollar is a very liquid currency pair. If, however, you perhaps, let's say, for example, went down into the emerging market space and you were trading something like the Filipino peso or even the Russian ruble, these markets are not known for a high level of liquidity, and breakout trading is dangerous because these markets tend to see and experience very significant wild swings without much warning in the marketplace. So breakout trading needs to be appropriate or is appropriate when markets are liquid. Just one final point on the liquidity of markets. Remember that even a pair such as euro-dollar can experience lower levels of liquidity at certain stages of the year. One very typical environment would be the final 2 weeks of each year leading into the holiday season. It's also a representation of the end of the year, so traders would tend to be closing their books, meaning that trading interest begins to decline. With trading interest beginning to decline, it means that liquidity is drying up, my apologies. With liquidity moving lower, perhaps considering breakout trading during that period might be a more dangerous option, or rather a more risky option. So with the fact that market sentiment issues that are important, establishing the phase of the trend that the market is in, recognizing a low volatility environment as well as liquidity market condition, it is then what makes sense that you need to always ask yourself what price action is telling you. So all of these factors will be facilitated by your constant evaluation and analysis of price action. Let's take a look at this particular chart over here. Now, first and foremost, let's do an evaluation of the price action that we have in front of us. We can go back and evaluate where the trend potentially started, which ultimately took prices up to where they are currently trading over here. We can see that there was a trend change, most likely down at the lower end of the price chart. If we then evaluate where a trend is actually confirmed, and remember, if we, for example, didn't have any of this price action to the right of the line that I've drawn, what we are able to do is recognize the fact that the markets have rebounded from these lows, have found resistance at that point. We've monitored this pullback in price action. We've noticed that once the markets start to recover, this pullback has failed to get below this particular low. We then focus our attention onto this resistance, and if broken, we will realize that we are now dealing with a sequence of higher highs and higher lows. In other words, we are dealing with an uptrend. Something that we looked at in previous webinars. Always focus your attention in terms of evaluating the trend in exactly the same way as I have just approached it. It's clear then, on the basis of what we've just mentioned, that a reversal would have been confirmed at the point that has been marked on the chart. In other words, while the trend change warning occurred earlier, the confirmation takes place at a slightly later point. And on the break of that particular level, we have then entered an environment where the market is clearly trending up. Now, if the market is clearly trending up, we can then consider breakout trading. So we can make a couple of assumptions. Once the trend is confirmed, firstly, a clear direction unfolds, and that is clear. Market sentiment is strong because prices are continuing to push or be pushed in an upward direction. The existence of this clear direction indicates that we are now dealing with a low volatility environment. In other words, everything above this level, as long as price action continues to move in an upward direction, tells us that the environment represents a low volatility condition. Therefore, range breakouts are appropriate once the trend has been confirmed. And you can see, simply just highlighted some levels that would have provided opportunities to consider a range breakout approach. Now, when we talk about, not range breakout, just breakout trading. When we talk about breakout trading, then what this essentially means is that you are trading in the direction of the trend, and you are trading when the trend confirms or registers a fresh high. In other words, you are trading the breakout of recent trend highs. What is important, as always with any trade, is that you need to identify your risk parameters. And if you recall, from a trend perspective, an uptrend is defined through its support levels, whereas a downtrend is defined through its resistance levels. So prior to actually taking a trade, we need to identify where our risk parameter is. And you can see that we've just simply highlighted the last corrective pullback prior to the resumption of the uptrend. Those levels mark your risk parameters. In other words, they will be the reference points that you will apply when you are trading your position in order to determine where you will place your stop loss. We can then also, just as terms of a final note, highlight that the activity leading up to the confirmation of the reversal can be seen as phase 1, whereas once the trend is defined, that is phase 2. So you can see we've been able to identify all of the components that are necessary before determining whether breakout trading is appropriate. We have a low volatility environment. Market sentiment is clearly strong. We've identified where the confirmation of the reversal has taken place. And that then means it is a low volatility environment and phase 2, therefore breakout trading is appropriate. Now, one additional point. So from breakout trading, we're then obviously focusing our attention on trading through these horizontal black lines. In other words, the levels above which the market confirms a resumption of the uptrend. If, for example, this was your first trend, or rather, my apologies, your first trade, and you place your stop loss at this point over here, you may adopt the approach that you will like to trade this market from a trend following perspective, and you will manage your risk accordingly as long as the uptrend remains intact. You follow price action to this high over here. You observe that a low is made at this point, and then the market continues to resume the uptrend. Therefore, you can shift your stop loss from this lower level up to this level now. In other words, you are trailing the stop loss. Again, once the market defines a corrective low and resumes the uptrend, the stop loss can shift from previous point to this level over here. And once again, the same process can be applied where the stop loss is then managed up to that point. Let's just assume, for the sake of simplicity in terms of illustrating the point, that you simply leave your stop loss there and you wait for further price trend information to make sure you raise your stop loss. Eventually, the position will be stopped out or closed at that level. However, having gone long at this point, you've clearly made a decent profit on the back of this trend. So there are many ways you can manage this trending environment from a breakout trading perspective. Either you can just trade each breakout and you can add to your overall portfolio, So in other words, each breakout trade represents a position that is added to the original trade. Or you can highlight a take profit level and then wait for your next opportunity to take a long position. Profit level, and once again, trade it accordingly. Important that you are able to understand under what conditions breakout trading is appropriate.